Pfizer faces FDA review delays on CRISPR-based sickle cell therapy. Cold chain logistics now in limbo. Tesla surges on Texas Gigafactory AI training breakthrough. Full self-driving version 12.5 pushes autonomy frontier. Microsoft jumps as Azure secures $4.2 billion DoD cloud contract. Classified AI workloads approved. The lab breaks it down now. Pfizer's lack of direct semiconductor exposure, given its pharmaceutical focus, limits its hardware-driven competitive strength, with no relevant die size or HBM3E bandwidth. High-bandwidth memory, a type of memory interface, to cite, making it less susceptible to silicon-related disruptions. The rising Fed rate, currently at 3.64%, poses a significant headwind for Pfizer Incorporated, potentially reducing its R&D budget by 5% and impacting valuation multiple. Visual, split screen, glossy Pfizer Incorporated press release on one side, a red-inked 10Q risk factors section on the other. Pfizer's public narrative, amplified by news of Telix's board expansion and MRK's ADC drug gaining FDA priority, emphasizes strategic positioning and pipeline strength. However, the lab notes zero significant insider activity in the last 90 days, despite an EPS beat of plus 14.3%. This suggests Pfizer's dominance in vaccine logistics, ultra-cold chain distribution networks, and its high-margin oncology franchise Ibrance, CDK4/6 inhibitor with 70% plus gross margins, form a durable revenue moat. But generic erosion of legacy drugs, chemical synthesis pathways now off-patent, and FDA biosimilar fast-tracking create hard volume ceilings, while cost. Tesla's hardware position is currently a liability, primarily due to the 5nm process node, which lags behind competitors leveraging more advanced nodes for AI training, impacting its cost per teraflop. While the D1 die size is a substantial 645 mm superscript 2, its reliance on an older node limits power efficiency and transistor. Visual, animated overlay of Fed rate hikes against Tesla's R&D spending, then a graphic showing normalizing yield curve. The dominant macro force hitting Tesla Incorporated right now is the Federal Reserve's sustained high interest rate environment, creating a significant headwind for its capital expenditure and consumer financing models. With the Fed rate at 3.64% and prediction markets pricing only a 20% chance of a rate cut by November 2026, Tesla management touts AI demand. But the lab hears a pivot from revenue growth to margin language, signaling potential top-line concerns, as insiders net sold 53,805 shares. We're long Tesla on its autonomous driving tech and software update advantages. However, risks include EU tariff policies and competitive EV investments. The lab's verdict. With an AI score of 42 out of 100, we're cautious, watching $343.25 support, issuing a hold signal. Microsoft's Azure data center hardware, powered by AMD's MI300X GPU with 128 GB HBM3E bandwidth at 5.2 TB per second, outpaces Amazon's Inferentia chip, making MSFT stock directly exposed to today's cloud computing demand. The rising Fed rate, currently at 3.64%, is a net headwind for Microsoft Corporation, potentially reducing its R&D budget by 5% and impacting valuation multiples. Management emphasizes AI demand, but their silence on slowing R&D growth versus revenue signals waning product pipeline conviction and likely 10Q risk factors would highlight supply chain vulnerabilities. Microsoft trades at $393.11, near key resistance of $399.41, with a bullish MACD and RSI of 66.1. The lab sees upside on Azure's AI infrastructure lead and Surface silicon integration. But CoWoS packaging constraints limit GPU supply, and Google's TPU v5 expansion threatens cloud margin. The real question ISN. Pfizer hold, Tesla caution, Microsoft buy, scores are live. Not financial advice. Do your own research. This is Denver Stock Lab out.